Welcome to Industrial Property Finance. I'm Georgina, and this is Episode 1, Industrial Property Finance in 2026, Rates, Deposits, Lender Criteria, and the Route to Term Debt. Before we start, the usual note. Industrial Property Finance is a trading name of Lenzie Consulting. We are a broker and introducer, not a lender, and we are not authorised by the Financial Conduct Authority. The lending we arrange is unregulated commercial lending, and where a deal involves a regulated element, we refer it to an appropriately regulated firm. Every figure in this episode is indicative market commentary, never an offer. The backdrop first. Industrial and logistics is the strongest performing corner of UK commercial property, and it is not close. Investment in the sector reached £10.5 billion in 2025 on Knight Frank's numbers. And the reason is simple. Constant demand from retailers, manufacturers, logistics operators, trades and growing businesses set against constrained supply. Units stay full, rents keep moving, and lenders want the asset class on their books. The Bank of England base rate sits at 3.75%, held since the cut in December 2025, which means the money behind these buildings is cheaper than it has been for most of the last 3 years. Now, the idea that organises everything else in this episode. Industrial lending splits into two credit stories. If you are buying a unit as an investment with a tenant paying rent, the lender underwrites the income, the rent roll, the tenant, the unexpired lease term, and how quickly the unit would re-let if that tenant left. If you are a business buying the unit you trade from, the lender underwrites the business, the accounts, the profits, and whether the trading cash flow covers the loan payments with room to spare. Same building, two completely different conversations, and knowing which conversation you are in is the first step in placing the deal. So what does the money cost in 2026? There is no single industrial mortgage rate. The rate is built from a reference rate plus a margin, and the margin is set by the asset, the leverage and the borrower. As an indicative guide, commercial term debt starts around 6% a year, development finance around 8% rolled up, and bridging around 0.75 to 1.1% per month. Lower leverage, stronger income cover, a good asset, and a clean track record all pull the margin down. The reverse pushes it up. Deposits next, because this is where most first-time industrial buyers are surprised. Deposit and loan to value are the same number seen from opposite ends. A 70% loan to value mortgage on a £500,000 unit is a £350,000 loan and a £150,000 deposit. Owner-occupiers with strong trading accounts can reach 70 to 80% loan to value, so deposits from around 20%. Investors letting units typically need around 30 to 35%. And watch the down valuation trap. Lenders lend against the lower of price and valuation. So if the valuer comes in under your agreed price, the shortfall lands on your deposit. On the investment side, the loan is sized twice. Once against value and once against income. Lenders want the net rent to cover the interest with a clear margin, commonly somewhere between 125 and 200%, depending on the lender and whether the rate is fixed. On a well-let unit, that test is comfortable. On a short lease or a weak tenant, the interest cover test can shrink the loan below the headline loan to value, which is why two deals at the same price can produce very different mortgages. Sometimes the answer is not a mortgage at all, at least not yet. An auction purchase completing in 28 days, a vacant unit that no term lender will touch until it is let, a yard bought before planning is sorted. That is bridging territory, indicatively 0.75 to 1.1% per month, interest rolled up or retained, with the exit, a refinance to term debt or a sale, agreed before anyone completes. And for ground-up schemes, trade parks and refurbishments, development finance runs to around 65 to 75% of cost and 60 to 65% of build value, from around 8% with interest rolled into the facility. The last piece is what happens after the purchase, because industrial debt is rarely a one-off event. Loans mature and reprice. Rents move and create equity that can be released against the rental income. Owners who started with bridging or development debt need a clean exit into a term loan. And landlords who have built up several units, often with several lenders and several renewal dates, can fold the whole patchwork into one portfolio facility, sized on the combined value and the whole rent roll, typically up to 65 to 70% of combined value. One lender, one review date, and usually a cleaner rate than the patchwork it replaced. So that is the map for 2026, the strongest occupier story in UK commercial property, 2 credit stories that decide how your deal is read, term debt from around 6%, bridging for speed, development finance for the build, and refinance and portfolio structures for everything that comes after. If you are weighing up a unit, a warehouse, a trade counter, or a yard, you will find the full breakdowns, the calculators, and every episode of this show at industrialpropertyfinance.co.uk. We sit across more than 100 lender relationships, and the whole job is knowing which desk genuinely backs which story. Thanks for listening. I'm Georgina, and this has been Industrial Property Finance.